What if the very foundation of Bitcoin, the promise of decentralization and financial freedom, was quietly being reshaped under our noses? Here's a thought that might keep you up at night. As Bitcoin achieves mainstream acceptance, the power to influence its future could be slipping into the hands of institutions like BlackRock. Yes, the same BlackRock managing trillions in assets worldwide. Now, before you brush this off as just another conspiracy theory, consider this. Over 1.1 million Bitcoins, more than 5% of the total supply, are already tied up in Bitcoin ETFs. Does that sound like a decentralized revolution to you? But here's where it gets even trickier. From decisions about Bitcoin forks to control over mining operations, the reach of institutions like BlackRock goes far beyond just holding Bitcoin. Could they sway the very rules of the game, choosing which version of Bitcoin thrives, or which transactions get prioritized? Welcome to the Chainpoint channel. In this video, you're about to uncover the layers of this unfolding story, the risks, the potential, and the uncomfortable truths that most people are ignoring. Let's explore the facts and the possibilities together. But before we continue our talk, don't forget to hit the subscribe button to stay tuned to what is happening in the crypto world. And remember, everything we say here is not an investment advice. Always invest wisely. Let's get started. So basically, over 1.1 million Bitcoins, more than what Satoshi Nakamoto is believed to own, are now held by a handful of Bitcoin ETFs. That's over 5% of Bitcoin's total supply, centralized under institutional entities. While this might seem like a sign of growing adoption and legitimacy for Bitcoin, it also raises an important question. What does this mean for decentralization? Bitcoin was created to empower individuals, yet this level of concentrated ownership might shift some of that power back to large institutions. The influence of major players like BlackRock extends beyond holding large amounts of Bitcoin. These institutions have the ability to shape the market in ways that are both subtle and profound. Consider regulatory changes that favor specific Bitcoin applications or discourage others. With so much Bitcoin under institutional control, decisions made by these entities could influence how the market reacts. For instance, if fees on centralized exchanges were to increase, the institutions holding the majority of Bitcoin's liquidity might indirectly steer pricing trends. Whether that's a benefit or a drawback depends on how those decisions align with broader network goals. So does this mean Bitcoin is losing its decentralized essence? Not necessarily, but the possibility is something worth keeping an eye on. Some see institutional involvement as a natural step in Bitcoin's evolution, while others worry it might undermine the network's original ethos. Whatever the outcome, it's clear that the landscape is shifting, and understanding these dynamics is crucial as we move forward. At the heart of this concern lies BlackRock's ability to decide which version of Bitcoin to support in the event of a fork. On the surface, this might seem like a mere technical decision, but the implications run far deeper. Imagine if BlackRock, with its vast influence, chose to back a proof-of-stake fork over Bitcoin's traditional proof-of-work system. Proof-of-stake, while energy efficient and increasingly popular, centralizes power with those who hold more coins, potentially undermining the decentralization that Bitcoin was built upon. Such a move could reshape the ecosystem, and not necessarily in ways aligned with Bitcoin's foundational principles. Proof-of-work, by contrast, relies on computational power to validate transactions, making it harder for any single entity to control the network. However, it's resource-intensive, has drawn criticism for its environmental impact. If BlackRock were to sway the market toward POS, it could set a precedent for corporate influence over Bitcoin's future. Would this decision be made in the best interest of the network and its users? Or would it prioritize institutional agendas, subtly steering Bitcoin towards centralization? The very fact that this question needs to be asked is cause for concern. While some might argue that institutional involvement like BlackRock's brings legitimacy and stability to the volatile crypto market, it also raises uneasy questions. Who gets to decide Bitcoin's future in times of conflict? Could a corporation's interests outweigh those of the broader community? And if so, what does that mean for the vision of a decentralized currency free from central control? These are questions we can't afford to ignore, as the answers may define Bitcoin's identity for generations to come. Bitcoin mining has evolved from a hobbyist pursuit to a full-fledged industrial operation, with publicly traded companies now dominating the scene. Today, nearly 1/3 of Bitcoin's hash rate is controlled by these companies, and many of them are backed by institutional giants like BlackRock, Vanguard, and State Street. This growing institutional presence might look like a step toward maturity for Bitcoin, but it also poses some challenging questions. When major asset managers hold significant stakes in mining companies, how much influence can they exert over the network? Take Marathon Digital, for example. BlackRock owns approximately 14% of this major Bitcoin mining player, with other institutions like Fidelity holding additional stakes. On the surface, this might seem like a vote of confidence in Bitcoin's long-term value. But what happens when regulatory pressures or economic interests come into play? If institutions like BlackRock decide to prioritize compliance with government mandates, they could influence mining operations in ways that undermine Bitcoin's decentralization. Imagine, for instance, certain transactions being censored to adhere to sanctions, a scenario that's not entirely hypothetical. This concentration of influence also raises questions about operational control. While miners are supposed to validate transactions independently, their reliance on funding and institutional backing could introduce subtle yet powerful forms of pressure. Could we one day see mining pools adjusting their priorities based on shareholder demands? And if so, what would that mean for the trustless nature of Bitcoin's network? These aren't just hypothetical scenarios. They're real concerns that highlight the delicate balance between growth and the core principles of decentralization. The answers might lie deeper in the network's ecosystem. Bitcoin's network is often celebrated for its decentralization, but what keeps it running isn't just miners and nodes, it's also the developers behind the Bitcoin core software. Miners validate transactions and secure the network, while nodes ensure the blockchain's integrity by independently verifying blocks. But the developers, they're the architects, crafting the rules that the entire ecosystem follows. This interplay between these groups is what makes Bitcoin resilient. Yet it's also a potential point of vulnerability, especially as institutional involvement deepens. Developers wield significant influence because they decide which updates or fixes are implemented in Bitcoin's protocol. This makes them targets for indirect pressure, especially when institutions or governments seek to shape the network's future. For example, funding initiatives like the one proposed by Van Eck donating 5% of ETF profits to Bitcoin core developers may seem like altruism at first glance. However, it raises the question, could such financial dependence compromise their objectivity? After all, developers funded by institutions might feel subtle expectations to align with their benefactors' interests. Then there's the issue of how miners interact with these decisions. While miners ultimately decide whether to adopt protocol updates, their economic ties to large asset managers might influence those choices. Imagine a scenario where BlackRock-backed mining pools subtly push for changes that favor regulatory compliance or profitability over decentralization. It's a slippery slope that could erode Bitcoin's trustless nature. If Bitcoin's governance starts tilting towards centralized decision-making, the very principles that make it unique could be at risk. And this isn't the only structural concern threatening decentralization. When you think about Bitcoin mining, it's easy to picture vast warehouses filled with machines working tirelessly to secure the network. But here's a surprising fact. Over 90% of those machines come from a single company, Bitmain. Based in China, Bitmain dominates the mining hardware market with its powerful ASIC miners, the backbone of Bitcoin's infrastructure. While their technology has fueled the industry's growth, this level of dominance introduces a significant risk. What happens if one company holds the keys to most of Bitcoin's mining power? The centralization of mining hardware isn't just a theoretical concern. If Bitmain were to face geopolitical pressures or economic disruptions, the ripple effects could destabilize the entire network. For example, imagine Bitmain going public and attracting institutional investors like BlackRock. Such a move could shift the company's priorities, aligning them more with shareholder interests than the broader Bitcoin community. Decisions about hardware, pricing, availability, or even technology updates could be influenced by corporate agendas, potentially steering the mining ecosystem in directions that don't align with decentralization. This isn't just about hardware, it's about the power dynamics it creates. Miners who rely exclusively on Bitmain's equipment are, in a way, tethered to the company's decisions. If institutions were to gain influence over Bitmain, it could lead to scenarios where mining becomes less about securing the network and more about serving centralized interests. This raises a troubling question. Can Bitcoin truly remain decentralized if the tools to mine it are so heavily centralized? The answer might lie in examining not just who holds the power, but how it's being used. One of Bitcoin's core promises is its resistance to censorship, a network where transactions are validated based on rules, not political agendas. Yet, even this principle has come under strain. In the past, institutions like F2Pool faced backlash for censoring certain transactions to comply with government sanctions. Although they later backtracked, the incident revealed a fragile underbelly of Bitcoin's decentralized ideals. As institutional players like BlackRock gain influence, the risk of similar scenarios only grows. Imagine a future where mining pools controlled by institutions are pressured to prioritize or exclude certain transactions based on political or regulatory mandates. For example, what if BlackRock's mining affiliates were required to block transactions involving sanctioned wallets? While such actions might align with legal obligations, they chip away at Bitcoin's promise of neutrality. This creates a slippery slope. Once censorship becomes acceptable in one instance, where does it stop? The network's ability to function as an apolitical system could be fundamentally compromised. And it's worth noting that the community often rallies against these threats, as seen in F2Pool's case. However, as institutional involvement deepens, the power dynamics may shift, making resistance more challenging. Could Bitcoin miners remain truly independent when their operations are intertwined with large financial entities? Or will Bitcoin adapt, finding new ways to protect its decentralized principles in an increasingly centralized world? Bitcoin's future has always been a topic of speculation, but the growing influence of institutions adds a layer of complexity to its trajectory. On one hand, institutional adoption could provide the stability and legitimacy needed for Bitcoin to cement itself as a global financial asset. On the other hand, the consolidation of power over mining, hardware production, and even protocol development raises concerns. Could the very forces bringing Bitcoin mainstream also be the ones steering it away from its original decentralized ethos? Consider the cumulative effect of what we've explored so far. Mining pools, heavily influenced by institutional shareholders, could face pressure to comply with regulatory demands, potentially leading to transaction censorship. Meanwhile, dominance in hardware manufacturing, like Bitmain's 90% market share, introduces vulnerabilities to geopolitical risks or corporate agendas. Add to that the possibility of developers being influenced by funding from ETFs or large corporations, and the picture becomes even more intricate. These dynamics, while not yet catastrophic, highlight the tightrope Bitcoin walks between growth and decentralization. As Bitcoin continues to mature, the decisions made today will ripple across its future. But for now, we're left with one burning question. Is this evolution a necessary compromise, or are we watching the start of Bitcoin's transformation into something it was never meant to be? So where does this leave us? Bitcoin's journey has always been about empowering individuals, challenging traditional systems, and creating a financial network that's truly decentralized. But with institutions like BlackRock stepping into the picture, we have to ask ourselves, are we witnessing the next stage of Bitcoin's evolution, or its transformation into something unrecognizable? The power dynamics we've explored, over mining, forks, and even hardware, are reshaping the network in ways that demand your attention. But here's the thing, Bitcoin's future isn't set in stone. It's still being written. If you found this journey eye-opening, don't stop here. Join the conversation, share your thoughts, and most importantly, subscribe to our channel. Hit that notification bell so you never miss what is happening in the crypto world. I will see you in the next video.